We are closing out a big week for the market and the economy. We've seen data showing inflation is cooling. We kicked off second quarter earnings with some upbeat results from PepsiCo, Delta, and some of the big banks. But there's still a lot of uncertainty about whether the U.S. is going to fall into a recession and the impact that could have on companies' future earnings. Well, here to help us navigate some of this uncertainty, some of his picks, and also some stocks to stay away from, we want to bring in Ben Kirby, Thornburg Investment Management, co-head of investments. Ben, it's good to see you here. So let's start with one of your picks, and it goes along the theme with bank earnings today, but you're looking at a name, Charles Schwab, one of the banks that was caught up in the regional crisis that we saw play out earlier this year. Why are you seeing a buying opportunity?
Yeah, well, thanks, Gray, for having me on the show. So look, I think the economy is slowing, so let's try to find some investments that can be resilient even as the economy slows. And we think Schwab is one of those. So Schwab is a very high quality, large cap, blue chip company. It's compounded earnings at 15% a year for the last decade, but the stock is down 30% this year while the market is up 17%. So Schwab used to trade at a 20% premium to the market. Today is a 20% discount to the market. We think that valuation will close over time. Schwab is not facing liquidity challenges. They're not facing solvency challenges. They have a near-term earnings headwind from higher rates. They're going to work through that, and we think the premium will come back over time.
But what about the crisis of confidence, though? Because we know so much of what happened and what played out with the regional banks and even the larger names was because consumers didn't know what to think. They didn't know how confident they should be in their banks. Is there still some lingering risk from that line of thinking?
There's still lingering concern, and I think that's the opportunity. Schwab is in a totally different bucket than some of the banks that were really challenged. Schwab has continued to get net new money inflows over this time period. We think that the bank is really not in any stress. They have liquidity. They're going to work their way through this, come out the other side, a stronger company, we think still with a very attractive growth profile.
And their executives, of course, have been extremely vocal just about their positioning amid all of that fear. All right, Ben, let's move on to your next pick, and that is BioMarin Pharmaceutical, one of the mid-cap biotech companies. What's the bull case here?
It's another name that's been left behind in the year where, again, S&P up 17, this name is down 17%. They just got approved for a really important drug called Roctavian, which is for hemophilia A, and it's going to significantly improve patients' quality of life. Instead of having to go to a treatment center on a regular basis, you can take Roctavian and you won't have to go there for 4 years. So it's going to significantly improve patients' quality of life. We think that peak sales for this drug are probably $1.1 billion or higher, and the stock's trading at about $85. We think that just on pure fundamentals alone, it's probably worth $120, maybe $130. And we think it's an attractive M&A target. And in an M&A scenario, it goes to $200. So we think maybe $10 of downside in the price and more than $100 in upside if things play out over the next 6 to 12 months.
All right, Ben, let's flip over to stocks that you're saying to avoid. And your first pick is a name that has certainly generated a number of headlines over the last couple of days, and that's Disney. We know CEO Bob Iger is going to stay on 2 years longer than initially he committed to. He also made some comments just about the strategy for Disney here going forward. Why aren't you too confident that he's going to right the ship quickly?
You know, Bob Iger is a great CEO, and the fact is Disney has great content. They have great brands. It's a great company. The problem is they have a lot of challenges facing them right now, and it's just going to take a while to turn it around. I mean, what's very clear, again, is the consumer is slowing, and Disney is exposed to that. We see parks visitation is down significantly in the current year. We've seen the reporting on that. So a cyclical component. They're also facing structural pressures from the decline of linear TV. That's impacting even ESPN as well as some of their other assets. And the direct-to-consumer business, the streaming business, is burning cash. And, you know, we think that they can maybe make break even in a year or two. But the fact is, it's not a great business. It's burning a lot of cash. So we just kind of put it all together, strengths aside. There's cyclical pressures. There are secular pressures. We think there's going to be better places to invest and kind of sidestep the slowing economy that Disney's going to get hit by.
Ben, speaking of the slowing economy, your next play that you're saying to avoid, or really a sector here at this point, or a group of stocks, I should say, is the buy now, pay later space. How much more weakness are you expecting to see from the consumer?
especially the low end consumer, I think is most at risk. So high end consumers, if you look at excess savings and sort of net wealth accumulation from home prices going up, from the stock market going up, from bond yields falling a little bit, all of those indicate that the high end consumer is still in a pretty decent position. The low end consumer, though, look, student loan payments are going to be coming back. Stimulus is gone, and they've worked through all their excess savings. And they've had a lot of tailwinds in the last few years that are going to be reversing. So a strong job market has led to rising wages. That's going to be reversing. And so we think that as we slow, you're going to see layoffs, you're going to see wage growth slow, and that should lead to, in a traditional cycle, and we think in this one as well, higher default rates among some of those lower income consumers. So it's a cycle, and we think that we're entering the slowdown phase. So stay away from those parts of the economy and those parts of the market that are going to be most exposed to it.
All right, Ben Kirby, great to get your picks. 2 names to buy, 2 names to avoid here as we look ahead to the remaining of the year. Ben, thanks so much.